Good afternoon. My name is James Pinchbeck. I'm a partner at Streets Chartered Accountants, and it's my pleasure to welcome you to our Autumn Budget and Spending Review presentation. This presentation will probably be slightly shorter than normal, given that there probably was less for businesses in the budget than we probably thought at the start. It genuinely seemed like a spending spree, with the Chancellor pledging £150 billion to the public sector for infrastructure projects and investments in education and health. This is on the back of the fact that the economy is likely to pick up before the outturn of the year to pre-pandemic levels, and setting the scene for optimism, an age of optimism, significant investment to support the economy. Hopefully, the Chancellor thinks this will actually trigger businesses to have confidence and invest in their organisations going forward. He also highlighted yesterday that actually the hiatus we're seeing in the supply chain and the rising energy costs are really part of a frustrated economy in light of the pandemic and increased demand by consumers as we get back to normal. So optimistically, perhaps that is a case that perhaps the economy may not bounce back as he predicts. But equally, as we said, the budget was light on business announcements and individual taxation announcements, but hopefully through the course of this presentation, we'll illustrate some of the aspects that were announced and some of the topics that were covered. I'm delighted for this presentation to be joined remotely by our corporate tax partner, Luke Prout, and in the room at our new hybrid style event, Kelly Goodchild, a tax manager with the practice, and also our financial planner, Sam Tindale. Rather than hold you up, we'll go on with the presentation. Can I ask if you've got questions, if you want to post them in the chat? For this format, we will answer those after the event. At the end of the presentation, there is also a copy of our budget summary, which you can download. But I will now pass over to Luke, who will do the first part of the presentation around corporate taxation. Thank you.
Good afternoon, everybody. Just following on from what James was saying, yesterday was rather light on announcements. More the Chancellor, Rishi Sunak, betting on the growth of the economy to be able to pay for the pledges he made yesterday. But there are a couple of, in the world of business tax and corporate tax, there were a couple of minor announcements made, which we'll go through today. But no, it was very interesting yesterday because I find it was what he didn't say. So when nothing is said, so we were expecting some tax rises, and they didn't happen yesterday. Now, we have to sort of bear in mind, it is the middle of a parliament, and a lot of the changes announced yesterday coming from 2023, which is at the end of a current parliament. So therefore, you would expect generally reforms happen at the beginning of the parliament for political reasons. So I watch this space because I do think changes will happen. I just think yesterday was the wrong time because, as Kelly would explain, there were some tax rises which were announced earlier in the month. Yesterday was probably the wrong time to announce tax rises, but it is watch this space, and I do expect there to be some changes in the next couple of years. So, looking at corporate tax, few changes. It's all about spending money. So one of the things Rishi discussed yesterday was about the UK being, now we've left Europe and we need to stand on our own feet. Obviously, the UK has got some of the top universities across the world, and people travel and they come here from across the world to study at our universities. So in terms of science and research and development, the UK for hundreds of years has always been a leader, and they want to accelerate that. And now we've left the shackles of Europe in terms of funding, so government funding to invest in R&D. They can spend a little bit more because we're not tied to things such as EU state aid rules. So there are grants and funding available to businesses. Now, grants and funding across lots of different sectors. So we're talking about agricultural, science, manufacturing sectors. There are grants available. So if you are looking to do to purchase new equipment, so capital expenditure, or looking to expand into an overseas market, there are grants available to allow you to do that. So please contact us, and we can look at that with you. The government has announced yesterday more money for those grants. Now, typically, most grants always have a jobs condition. So to be able to apply for a grant, you've got to say, for example, you're buying a piece of machinery for £200,000, of which you want a grant towards that. Some of the conditions, one of the conditions generally is creation of jobs. So bear that in mind, but please do speak to us. But no, there are changes. So the research and development tax credits, which for 2020, so 2021 statistics haven't been released, but 2020, there are about 86,000 claims made across the UK, of which 76,000 were made by the small and medium entity sector. So companies, so a lot of clients that are on this video today, and some clients that I recognise that I've claimed for. Now, a few changes. Something that's been discussed for a couple of years is data and cloud costs. So when R&D, so the R&D tax credits have been around since the year 2000, so for 21 years. So if you spoke about the cloud in 2020, 2000, the cloud was something in the sky. Whereas you talk about the cloud today, it's very, very different. So the rules have been amended to include costs for data and for cloud computing when you are looking at R&D expenditure. So, for example, you can have computers in the cloud to do the calculations, to do the grinding of some R&D projects. Well, those costs can be claimed now. It's been in consultation now for a couple of years, so that's it was expected, and it is a welcome change. And to be honest, HMRC have been allowing these costs for a few years now, so it's just putting it on a statutory footing. One of the other changes, which they announced very briefly yesterday, but there's been we will get some further details in regards to R&D tax relief, are to ensure that the relief is being given for R&D carried out in the UK. So similar to the patent box regime, where they changed that a few years ago, because under the patent box regime, you could have a worldwide patent. The patent could be held outside the UK, and it still could qualify. So they brought that back into the UK, that the patent must be created from UK R&D. Well, it's the same for R&D. They are looking to make sure that the R&D tax relief is given for R&D carried out in the UK. So currently, and we do have a few clients where we have a UK company, it's registered for corporation tax here, but the R&D is carried out. I've got one client, for example, that carries out R&D in Poland and New Zealand. Nothing is done in the UK whatsoever, but they still qualify for R&D under the current rules, because it's a UK company and the costs are qualifying. So they are looking at attributing spend to make sure that the relief is given for R&D carried out here and not elsewhere. Very similar to regimes across the world. So just very quickly on R&D, if you're currently not claiming, you do need to speak to us, to your audit, to your engagement partner, or to a tax partner like myself, because for SMEs, you can claim up to 33% for every pound spent. If you're loss making, if you're profit making, it's up to 25%. If you're a large company, then that's 11%. So these are genuine tax reliefs, and it is the most generous tax relief that HMRC give for companies. So what qualifies as an SME? So fewer than 500 staff, turnover not more than 100 million euros, or gross assets less than 86 million euros. So many businesses will fall in the SME category, and then obviously the reverse for large companies. So when can you claim R&D relief? Well, if you are doing something to resolve scientific or technological uncertainties, and that could be across many sectors, across many things. So you don't need to wear white coats to claim R&D tax relief. You could be looking at current products, changes to products, internal processes, internal manufacturing techniques, waste reduction. It could be something that's not linked to a product you sell, but how you make the product. So maybe in a more cost-efficient manner that is innovative. Then do please speak to us, because there are lots of reliefs there. What can you claim? Well, you can claim staff costs, so payroll costs, so gross payroll costs, so salaries, employers' national insurance, pension contributions, reimbursed expenses for R&D duties. If you subcontract some of your claims out, then under certain circumstances you can claim your subcontracted costs. Materials, so consumable items, so anything you use up to, so for example, if you are a rubber manufacturer and you're coming up with new recipes, you'll probably spend a lot of money working on products that might not actually work, but the costs of those are completely deductible. So the R&D doesn't have to be successful for it to qualify. It can be for abandoned or aborted projects. Software, to some certain types of software, and then from what was announced yesterday, data and cloud costs. So it's definitely worth considering, and statistics show that there are a lot of businesses that don't claim these reliefs when they are entitled to do that. And as I say, as a service, we do the calculation, but we also prepare the compliant HMRC reports to accompany the tax return. So we do offer a full service there to ensure that the claims are correctly. And then another announcement was made in regards to capital expenditure on plant and machinery. So the annual investment allowance of so the first £1 million a year, of which you get 100% tax relief, was due to end at the end of that was 31st of December 2021, not 2020. That was my error in the slide. But that's been cancelled now. That has been extended to 31st of March 2023, which is in line with the super deduction, which was announced earlier this year. So between now and March 2023 is the time to spend. The government want you to spend on plant and machinery assets, because now is the time you will get the best tax relief. I must get 2 or 3 queries a week from clients asking me, will this qualify for super deduction? Will that qualify for super deduction? Please ask us, because we will tell you, yes, it will. Or no, it won't in certain circumstances. So what is the super deduction? So it's only available to companies. It's for plant and machinery assets. New assets are not second-hand, not cars. You can't transfer something from a company to another company and claim. Can't be gifts. Can't be in the year you cease trading. It can be for leased assets. So, for example, I've got a few holiday parks where they purchase caravans for lettings. They qualify. What's the relief you get? Well, you get 130% of what you spend. So if you spend £100,000 on a caravan or a lodge, you'll get tax relief for 130% of the expenditure. So it's very, very powerful. Why is it 130%? Well, it's because we have a corporate tax rise coming in from April 2023, which I'll discuss in a moment. So, and then for items that aren't plant machinery, so we're looking at hot and cold water systems, heating systems, electrical systems. There is a slightly watered down version, but you get a 50% first year allowance. So, which based on that, if you add that with the £1 million AIA, that makes the AIA worth £2 million to April 2023. So if you're looking at refurbishing business premises or doing extensions to your office premises or care homes, for example, adding further bedrooms, now is the time to do that. And then finally, I'm just going to cover the increase in corporation tax from April 2023. So that was announced earlier in the year. It's an increase to 25% for profits above profits at over 250,000. We will still have a 19% rate if your profits are below 50,000, and then between 19 and 25, we have what's called a marginal rate, which is effectively at 26.5%. The reason why it does that, I do have another slide on how the marginal relief works, but I haven't included that today because I only have 20 minutes to do my segment. But effectively, the 26.5% rate is a level. It levels out the rate, the transition between 19 and 25. So basically, if your profits are between 50 and 250, then you obtain tax relief 26.5% by bringing your profits down to 50,000. So things like the super deduction, so capital allowances, will bring your profits down. Now, Rishi did mention yesterday he wants to bring taxes down. He said that twice. So this is from April 2023. It was announced earlier in the year. So the cynic in me thinks, it may happen that from April 2023 is the end of a parliament, so he could bring that down a couple of percentage points in maybe 2022 or 2023's budget announcements as his rabbit in the hat. So while it is legislated to go up to 25%, it could come down, and I think, if you was asking my opinion, I think that will come down a couple of percentage points. Now, I do have a couple of questions, so I will answer these questions. Can you claim university fees? I assume that's to do with R&D tax relief. Yes, university studies. So if you're paying for a university, for university staff or university trials, then yes, you can have those. In certain circumstances you can't, but yes, you can. Are capital allowances available to IT infrastructure, laptop screens? Most definitely they are. Is a super deduction allowable on vans? Yes, they are. So yes, if you buy vans, you will get relief at 130%, and a van is a van. So if it is I can talk about the difference between cars and vans, and you have that hybrid sort of double cab pickup that sits in the middle. Is it a car? Is it a van? There's lots of case law around that. But a transit will qualify for the super deduction. And we're moving on to an ERP system. Is this deductible? Yes, software. So again, software is software. You have a bit of a hybrid. So you could claim plant machinery allowances. You could claim intangible relief. I'll be electing to claim plant machinery allowances during the super deduction because it's 130%. But yes, software qualifies as plant and machinery. So it is very, very wide scoping. As I say, you've got till March 2023 and to spend. So use it or lose it. And as I say, if any queries, please run it past us, and we'll give you the advice. And I'm very grateful to say I am 15 seconds early, which is remarkable for me because usually I can go on way beyond my 20 minutes. So thank you very much for listening to me this morning. Any queries, please drop me an email.
Thanks for that, Luke. clicker. Right, I'm going to talk about now, thank you very much, what has happened in the personal tax world, which is not an awful lot, to be honest. If you watched the budget yesterday, Mr. Sunak didn't really talk about how he was going to pay for all of these things that he said he was going to dish out the cash for. So, but I'm going to sort of unpick what he spoke and go through the finer detail of where this money is actually going to come from. So I'm going to talk about rates and allowances, health and social care levy, the basis period reform, the government grants and the SEISS payments that people received during the pandemic, and capital gains tax and inheritance tax. So first up, rates and allowances. So no changes, which might sound like a good thing, and in a way, I guess it is. However, if you look at it, these allowances and rates have been fixed for 5 years. So 5 years down the line, when inflation will have gone up, costs will have gone up, hopefully maybe wages will have gone up, you're still going to only get the £12,570 tax-free allowance. So really, what he's doing is he's increasing the tax without increasing the actual tax rates and allowances. So you're going to be paying more tax potentially at the higher rates or falling into tax where before you wouldn't have. So just going through the rates, just to refresh your memories, is personal allowance 12,570. So that will be that now until 25-26. Basic rate band, so you can earn just over £50,000 altogether before you start paying higher rate tax of 40%. And then the additional rate band is £150,000 where you pay 45%. Also, no change for IHT. I'll come on to that a little bit later, or CGT. So the allowances for those stay exactly the same. And again, the pensions lifetime allowance, Sam's going to talk a little bit about that in a moment's time, but again, also fixed. So where things are growing and increasing in value, all of these are staying the same. I thought I would just also mention, let me see if I can get it to go. This would increase the a lower person's income by about £1,000 a year, which is brilliant, obviously, for those on lower incomes. This is a person that's working full time on national living wage. However, I think the flip side of that is the burden for the employer. He is now, or she is now going to be paying that employee an additional £1,000 a year. So if you do have a lot of employees on that baseline, then they will be paying another £1,000 for their wages for that year. It's still not moving. Sorry, just having a little bit of a technical hitch with the slide. Can you put me along the slide? Sorry about this. So to the next slide, please, Mike. Oh, I feel like I'm like on one of those press announcements. Next slide. Anyway, so now I'm going to talk about the health and social care levy. So this was announced by Boris back in September, and this is the additional 1.25% that we're all going to have to pay to help out with health and social care. So from April next year, the 1.25% will come in, and it will be like an additional national insurance charge. So will be added to the deductions in your wages if you're an employee. I think another thing that you do need to think about is if you're an employer, that 1.25% is also a charge for you. So that's sort of another flip side, an additional cost for an employer. It's going to be levied through Class 1 and Class 4. So Class 1 is employer and employee contributions. Class 4 is for those of you that are self-employed. And as I said, it's going to be an extra 1.25%. So between April 2022 and April 2023, that additional income for the government is going to be paid directly to the NHS. So that is all going to go to the NHS in that first year, which I don't think any of us really could argue about, to be honest. But then from April 2023, the levy is going to have its own status, as it were. So because obviously they've brought it in quite quickly, they've had to kind of add it onto the national insurance charge, whereas from April 2023 it's going to have its own status. And also from 2023, persons of a state pension age that are still working, so over however you will be when you get your state pension up to 67, you will then be charged the 1.25%, because obviously you don't pay national insurance if you're state pension age, but this is going to be a separate levy altogether. So, and then from 2023, all of the additional income that the government get from this levy is going to be distributed to the whole of the UK to cover all health and social care costs. Next slide, please. Thanks. That was announced at the same time as this, which I think was kind of slipped under the carpet a little bit really, was the increase in dividend tax. So as we all know, at the moment, dividend tax rates are fairly low, which makes remuneration planning we do it the way that we do, with sort of small salary topped up with dividends. But the dividend rates are going up by 1.25%, so not a huge amount. But it's sort of sneaky little bits in that, you know, sort of gone under the radar slightly. What this would mean, if we were doing tax planning for a small company, we would recommend taking a small salary, say 9,500, topped up to the basic rate bands with dividends. If we carry on doing that type of planning for that type of client, that's going to cost them an extra £300 per year in tax. So it might be time to have a look at your remuneration package. Think about how you're extracting the funds from your company. Is there a more tax efficient way we can do that? Is there a better way where we can bring, you know, other shareholders in, wives, children, that kind of thing? So it might be time just to have a word with whoever deals with you at Streets, just to look at that and make sure you're still getting really good sort of tax advantage and tax planning to the best of your ability. So moving on now to the basis period reform. Again, this has not had an awful lot of press. They're bringing it in to align people that are self-employed and partnerships to MTD, Making Tax Digital. You might have all heard of that, where HMRC want businesses, partnerships, trusts with trading income, and for people with property income over £10,000 to report quarterly what their income and what their expenses are. So to align people with accounts that don't fall in with a tax year, what they are going to, well, what have they put forward and what is going to go through is that they are going to align your income with a tax year. So for instance, if you had a tax year of the 30th of September this year, so 30th of September 2021, your accounts period from October to September would be taxed in 21-22 tax year, and you would be taxed on those 12 months even though it doesn't fit into that tax year. Going forward, there's going to be a transitional year where if we took this year as that transitional year, you would be taxed on the income for that year plus to the 5th of April to then bring you in line. And then going forward, you would be taxed from April to April, April to April. So whether your accounts, HMRC are not going to take any notice basically of your accounts, and they're going to bring you in line. So what this means is you won't pay more tax, but the tax is going to be accelerated. So the revenue are going to get it quicker. So the figures are quite astronomical, how much they're going to get from this brought forward. So it might be time to look now. We're certainly doing it for our clients, where we're looking at what your income has been, because obviously we've had the pandemic, profits might be low, things might have been a bit dire. So the profits in this year might actually be really quite sort of reduced. So it might be a good time to change that year end now, get in before the profits are making a rise and coming back up again. So as I said, it's kind of been under the radar again, this one. Not a lot of press about it, not a lot of talking about it, but could have quite a detrimental effect. So certainly for our clients, as I said, we are looking at maybe making that change now, ready for a couple of years' time when it's going to be brought in anyway. So moving on to the self-employment income support scheme grants and business grants. These are all taxable and must be included on your tax return. Furlough is obviously a different story because that's taxed as income, employment income, so will have been taxed, and national insurance and everything as your salary would be. So you don't need to worry about that. It's the SEISS grants and the local government grants that do need to go on your tax return. There's a special box to put them in on the tax return, so HMRC can easily identify them. HMRC will obviously already have the details, so it will be a case of checking the number on your tax return against the number that they've got in their system. If you're a sole trader or a partner that applied for a grant and kept the grant yourself, so if you're a partner that kept the grant yourself, it will go on your personal tax return. If you're a partner in a partnership that applied for the grant but left it within the partnership to keep the partnership going, to pay costs, that kind of thing, it will be left in the partnership, accounted for in the profits, and distributed between the partners. So that also is a little thing that we need to look out for and make sure that we're taxing it on the right person and in the right place. Leading on from that, as you are putting on the tax return that this is the amount that you've received, there's also a declaration on the tax return this year, an additional one, that says you agree that these are the figures that you've had, you were entitled to the figures when you claimed them, and you don't owe anything back. So if you applied for your grant and at the time of the grant you thought that you were eligible, I'm not going to go into right now about how, you know, what the stipulations were for that, but if you thought you were eligible at the time and you applied for the grant and it actually turns out that you're now not, how you pay that back is through your self-assessment. So this goes on your self-assessment tax return, and you have to declare it and tick this declaration and sign to say that that's all true and correct. HMRC are going to be looking at them, I will just forewarn you. Moving on to the next thing, just another couple of grants and things that you need to think about that are going to be taxed. The coronavirus job retention scheme, so the furlough scheme paid to employers, that is an income that will need to go within the accounts for you. The £500 test and trace isolation payments, I don't know anybody that claimed that, but it's there and it's taxable. So whether that will come out in the wash, I don't know really. Restart grants and payments that were received under the Eat Out to Help Out scheme also need to go on as income. So during the pandemic, the government announced these bounce back loans. Now, I'm sure most people have heard of the bounce back loans. They were there to help businesses, keep them afloat. A good opportunity maybe to buy capital allowances, as Luke spoke about earlier about the deductions you can get for capital allowances. It was a good scheme, and the interest rates were so low. Even if it was to borrow to pay off other loans and things, to get the interest rate so low and the good terms and conditions to them. Fortunately, they've now finished, but what has been put in their place is the recovery loan scheme, which is again a government-backed scheme where businesses can claim up to a loan of £2 million. This has just been extended actually to June 2022. So if this is something that you think that your business needs, would benefit from, then again, get in touch. We can help you with the applications. And again, the rates are good rates. So it might be something that you want to investigate and look at taking out. So moving on then to really well, one before my last slide really, is capital gains tax and inheritance tax. Nothing changed, which there was lots of talk and speculation about capital gains tax, but actually in the big scheme, in the bigger picture, capital gains tax doesn't raise that much revenue. But we did still think there were going to be changes. We did think they were going to bring in line the capital gains tax on residential properties in line with the rates of 20 and 40%, but they haven't. They've left them at 18 and 28. They've left the thresholds the same, where, as I spoke about the allowances before, what have stayed the same. They've done the same with inheritance tax and capital gains tax. Again, a stealth kind of tax, I think, because assets are only increasing in value, houses are only increasing in value. So you are probably going to fall foul or tip over those limits quite easily and quite quickly. Again, they're fixed till 25-26, so that's a whole 5 years. One very, very welcome change was that they extended the 30-day CGT return for the sale of residential property to 60 days, which, if any of you have sold a property in the last 18 months, you will know it's a nightmare to get all of the information gathered, the account set up, the tax paid within that 30 days. So that is a very welcome extension to 60 days. Still, a fairly small amount of time, but definitely give us more time to get the information together and get everything set up and get the tax paid over. So really, I think all I wanted to say regarding and around capital gains tax and inheritance tax is planning. If you have got a sale coming up of a property, speak to us first. If you think the inheritance tax threshold, so you've got £325,000 per person and £175,000 for your property, for your business, your property band. So altogether £500,000 per person. So as a couple, you've got £1 million, which might seem, a fairly generous amount, but it really doesn't take that much to tip over that with property prices. And also you've got to think that, £350,000 for your property is probably, is probably going to exceed that fairly quickly. So again, planning, come to us, speak to us, see what we can do. There are lots of, IHG friendly investments that our financial arm can help you with. There's lots of planning that can be done, little bit movements in assets and things that can potentially set. 40% is a high rate of tax, and it's 40% of your inheritance you're giving to your children and your grandchildren. So even a small movement can save quite a lot of tax in that situation. So moving on to stamp duty land tax. The stamp duty land tax holiday was amazing. It was brilliant. So up to £500,000, you could buy a house and not pay any stamp duty land tax, which was saving people £15,000. It was absolutely fantastic and definitely got the market going without a doubt. The thing on the figures on the side, house prices increased in June 2021 by 13.8%, which is the biggest rise since November 2014. So it definitely got things going, as I think what the purpose of it was. But what now? We've got no stamp duty land tax. So the rates have gone back to their pre-COVID amounts. So up to 125, you've got nil. No stamp duty land tax. Between 125 and 250, it goes up into 2%, 5%, 10%. So it goes up. So it's back to what it was before. Is that going to have an impact? I spoke to an estate agent a couple of weeks ago, and he said the market is still pretty good. We're now thinking about how we work from home, how we live. We've spent an awful lot of time in our houses, maybe going stir crazy. And he said lots and lots of people are upsizing. That's what the majority of what's going through his books at the moment. So I still think there's definitely going to be quite a lot of movement on the property market. Always help for first-time buyers, which is brilliant. It's no stamp duty up to £300,000 and only 5% up to £500,000, which is really, really good. And also, which is brilliant, and some of us probably will remember getting our first mortgage like this, high street lenders are offering 95% mortgages now under a government guaranteed scheme. So buyers only need to get a 5% deposit, which is really, really good, really good. So just moving on. So finally, I had to finish on this slide. I am a happy lady, 87 pence off my bottle of Prosecco. Rishi Sunak has announced a complete radicalisation of the alcohol duty and excise, which basically is something like 327 years old. So it's going to be now based on the percentage of alcohol that a drink has. So basically, the lower the alcohol, the lower the duty excise on it. So, which is going to benefit smaller breweries producing lower percentage alcohols like Adnams. Is going to be 25% less for a pint at the pub. So unfortunately, it's not so great for those of you that drink red wine. That's going to go up by about 47 pence a bottle. So maybe you need to switch to Prosecco. Right, thank you ever so much for listening to me. If you've got any questions, then please put them in the chat box and we will get them answered after we've finished. So I'm going to pass you on to Sam now, who is from our financial planning arm, and he's going to update you on his bits and bobs. Thank you.
Hi everyone, Sam Tindale, Managing Director and Chartered Financial Planner at Tower House Wealth Management. I've got a brief agenda today, hopefully about 10 minutes or so, just to wrap up today's presentation. Next slide, please. So just going over what I'm going to cover, slightly different angle. Firstly, just have a look at the investment markets, because there's been a lot of economic noise, so actually see what that's impacted. Probably continue along this discussion about real assets and what's happening with their values. Look a little bit at the budget itself, but the general vein of today is that actually there's not a lot to say, and it's very much the same for financial services. So we'll look at what's changed, what's not changed, and then I'd like to try and finish with some positivity and look at some of the opportunities that present themselves, not just in terms of timing and now between future budgets and potentially having to pay back some of the cost of COVID and the cost of all these grand plans, but also just some of the basics as well that we should be considering. So next slide. So the investment markets in 2021, so this is year to date really, only a couple of minutes on this, but there's been a lot going on. I think everyone's been really focused in on COVID, but actually when you look at the things that are sort of presenting a risk at the moment, inflation is probably the biggest headline, and what we call stagflation, which is stagnant growth and high inflation, that presents a big risk. So almost on a monthly basis, we're seeing inflation jump all over the place, and it's poised to be high for a good 12 months at least, I suspect. Brexit's still having an impact in the background, but more than anything, this is probably to do with the global supply chain. I was trying to find a catchy photo, but I couldn't find one that quite did it justice. But effectively, I'm sure we've all seen on the news, there's photos of shipping containers sat out in the seas. They can't get into ports. The ports in the UK are absolutely filled, so we're having to send goods back to Europe and then get them shipped across on smaller ships. And all that's doing is pushing the cost of goods up in the UK like exponentially. We're all coming out of COVID, and generally speaking, people have got more money to spend. And therefore, the cost of goods is rising as well because demand's really high. So that's sort of impacting the markets as well. Coronavirus obviously continues to be an ongoing issue. And then I think the UK specifically has got its own fair share of issues, again, because of leaving Europe and generally sort of with supply. But in numbers, on the next slide, you'll see that it doesn't actually necessarily equate through to a, can I have the next slide, please? It doesn't actually necessarily equate through to a bad year. So all that we're looking at there is just the S&P, the FTSE, the MSCI World. So kind of a measure of how world markets are looking. And I mean, look at the top of there, the S&P 500 has performed at about 22% year to date. So there are some astronomical growth figures out there. A lot of question about things like valuation. This is what we're speaking to clients about, the sort of value of US equities. Are the tech companies overvalued and these type of things? But as you can see, the sort of key message is that real assets, Kelly's obviously touched on property, but the equity markets have continued to grow a lot as well. Now, where I think this presents the biggest issue is spoke about all the rates being frozen, and IHT has been £325,000 per person for quite a while. Yes, they've given us the addition for residents, but actually, if you've got a large investment portfolio and that's grown by 10 to 20% in 1 year, we're vastly outgrowing the rate that the allowances are that we've got in play at the moment. And I think what we're ending up with now is, I think the figures came out for July, huge numbers coming in inheritance tax receipts. So Kelly's right to sort of major on that as a topic at the moment. The interesting thing on this slide as well is that there's that virtually stagnant line you can see at the very bottom. That's a money back average 90-day notice account, and that's 0.3% year to date. So the issue of trying to get a decent return on cash is harder than ever. And you couple that with higher inflation, effectively money sat in the bank now is just losing value in real terms. So just an interesting backdrop again to see where things are sat. What's changed? That I'll leave this up for a while so everyone can dive it. It's quite a busy slide, but quite honestly, not a lot. There's very, very little change for financial services, very little change for tax that Kelly's come on to. So what I'll look at more is what's not changed in the budget. So on the next slide, you can see there, I put the annual allowance for pensions is up to 40,000. The annual allowance, once upon a time, we only had one annual allowance. We now have about 3 or 4. So you have an annual allowance depending on how much you earn. So if you're a higher earner, going over £200,000 a year of income, you start to lose how much you can pay into a pension. If you previously flexibly access your pension as well, you're also restricted to only paying £4,000 a year in. What I'm seeing is people that have made decisions in the last couple of years where they've maybe taken tax-free cash or started taking income, not spoken to someone, and then they sort of tripped themselves up down the line when they've gone to try and do some tax planning, or maybe they spoke to their accountant and they've suggested some company pension contributions, and those doors have been closed. So I think more than ever now, just taking the time to speak to someone if you are thinking about accessing your pension is a good idea. Corporation tax treatment of pensions. So I think, when putting these slides together, I was trying to think about, what do we talk to clients about a lot? We're predominantly in the SME marketplace. Corporation tax relief on pensions is still a huge area. We do a lot of pensions business. They are still corporation tax deductible. So in a world where corporation tax rates are going up, I think they'll be more attractive than ever to consider using pensions as a way to extract profit from a business. So if you're already taking, reasonable dividends, you're taking salary, depending on how that's structured, consider pensions as another way to pull some profit out. The personal pension tax relief, that's also remained the same. So again, another area that gets a massive amount of speculation when we come to budget. Is will they adjust this idea that at the minute, if you're a higher rate taxpayer and additional rate taxpayer, you get the highest rate of your highest marginal rate of tax relief in your pension contribution. So if you're additional rate taxpayer, you get 45% tax relief on what we pay in pension. All in all, pensions cost the government about £40 billion a year in tax relief. So it's a really, really, really generous area, and one that everybody can get some speculation around. Nothing's changed at the moment, but again, I think this is another one of the things we've got to watch this space. CGT rates, IHT rates, again, we've covered those, so I won't go into them in any more depth. And the ISA allowance has been bumped up a lot over the last few years. So we're now at £20,000 per person and £9,000 per child for a junior ISA. It is the highest ISA allowance has ever been by historical standards. So again, it's a use it or lose it allowance. If you've got excess personal savings, even if you just utilise it with cash, if you're using that allowance every year, it gives you options in the future. So you can move between stocks and shares ISAs and cash ISAs, ring fence within that ISA allowance. So it's, again, just worth using it. Next slide, please. Future risks. So one that Kelly touched on, and one that I almost was convinced they might do this because there was so much noise out there, was we've obviously seen a lot of movement on how the government are taxing landlords and how they're taxing property owners. One thing that was being leaked beforehand was that this idea of moving CGT rates in line with income tax. And then it kind of pulled back a bit, and then they said they might just increase it just for the sale of property. So again, a bit of a no smoke without fire. It's something we've got to watch. CGT is seen as a tax on the wealthy because those with assets are deemed to be wealthy in the eyes of this world. So again, it's probably going to be a more popular tax to go after. Single rate tax relief, so as I mentioned on the last slide, you still get your highest rate of tax relief on pension contributions at the moment. It's considered to be overly generous. I mean, my next slide goes on to really look at pensions and why they're overly generous. But there's been this rumour about having a single rate of tax relief for a while, and effectively what that would do is potentially get rid of the additional and higher rate tax relief and cap it off. The rumours have been around 20-25%, which would be a real blow for sort of higher earners. Who would save the government a lot of money. And then I think, again, future risk changes to IHT. The government have taken in more money in IHT than ever before. And again, this is because real asset prices are going up and the rates have remained stagnant for years and years and years. And it's huge numbers of money that they're bringing in IHT. We joke in our industry, we call IHT the voluntary tax because it's actually one of the taxes you can do a lot about. So, whereas income, if you're in a high paid job, it can be quite restrictive to plan. With inheritance tax, asset based, there are a lot of things you can do that are inheritance tax friendly. On my next slide, we're just looking at the pensions are there and how they work with IHT. And this is where I think they're overly generous and why the government have probably got their eyes on them. So 2 scenarios here. We've got couple 1 and couple 2. Couple 1, both couples have got a £3 million estate. Couple 1 have a main residence worth 1 million, and then they have buy-to-let property and cash of 2 million. And then couple 2 have a main residence of 1 million and a pension each of 1 million. So both £3 million estates. Couple 1 would pay a minimum of about £800,000 in inheritance tax on their £3 million estate. So and that's based on the fact that cash and buy-to-lets are generally speaking IHT-able. Their main residence and their nil rate bands are all getting used up by that £1 million property. So it's £800,000 as a minimum, but actually they would go on to subsequently lose that allowance that they're given specifically towards the main residence because their estate's over 2 million. They then start to lose that as well. So it's kind of a double hit for them. So I say it'd be a minimum of 800,000. It'd likely be more. Couple 2, main residence of 1 million and then a pension each of 1 million. They would pay no inheritance tax. So when you compare those 2 positions, 2 people, two families that have both worked hard, both saved hard, both just chose different assets to save into, and a substantially different inheritance tax position. And that's fundamentally because pensions are outside of the estate for inheritance tax. So again, just another area that I think seems overly generous in today's world, and especially something they may look at when they're trying to find some money in the future. Opportunities. So we always talk about, in our world about pensions being a corporation tax deductible asset. But what we don't talk about is some of the other things that we see a lot as well. So relevant life planning. There was a survey done recently by a provider who came back and said that around only 22% of business owners were actually aware of relevant life plans at all. All a relevant life plan is a life insurance policy that's paid for by your limited company. It is corporate tax deductible, so you save 19% or whatever the premium is, and you insure, say a director insures himself, and it's not a benefit in kind. So if you're a higher rate paying director, you've got a limited company sat there in the background. By using a relevant life policy as opposed to arranging personal protection, generally speaking, you probably save about 50% in tax. So it's an absolutely mammoth saving. Your insurances might not be, your life insurances might not be huge figures, but in my view, every little helps. And it's a simpler sort of looking at a different way of paying for that policy. And again, executive income protection. A lot of people out there have income protection policies designed to cover their income if they're off work due to accident or illness. But a lot of people miss executive income protection policies, which again, paid for by the business and corporation tax deductible. So potentially another really attractive way to try and plan. So just coming at it from, maybe a couple of different ideas that we've not discussed in the past. The ISA for a family of 4 now, £58,000 per year. So again, if you've got high net personal wealth, a fantastic way to use sort of tax-free allowances, no income tax, no capital gains tax on ISAs. The one thing to watch though is that ISAs are taxable for inheritance tax. So whilst they're brilliant for building up throughout lifetime, they can present a risk later in life, which is why when you sort of look at my next point there, people more than ever are considering things like converting ISAs over to pensions in later in life. So again, it's something you want to discuss. It's best to talk to an advisor about it to make sure you're playing within all the rules. But as long as you've got the net relevant earnings to do it, more than ever, we're seeing people move ISA funds over into pensions and get an income tax relief, but fundamentally moving those funds outside their estate. So just something we're seeing a bit more of. Another point there that I think people have been concerned about. I had loads of calls on this in 2020 and 2021. Financial service compensation scheme. People were worried about the banks. People were worried about financial security. So again, there's premium bonds, there's NS&I based investments. National savings and investments are government backed. They've got 100% cover under the Financial Services Compensation Scheme with no upper limit. So if you're looking for a really easy way to protect a large sum of personal cash, whereas the bank may only be covering you up to 85,000, NS&I offer an alternative route to do that. And there's quite a lot of companies out there now as well that will do, you can establish one account with them and then they'll spread it out over a number of underlying accounts to protect your funds better. So just another point that we see quite a lot of. If you want to move on. That's me. I'll hand over to James just to do a bit of a close. If anyone's got any questions, as I say, if you can pop those in the chat and we'll endeavour to answer anything. And our contact details are obviously available through the main website. Thank you ever so much.
Thank you, Sam. I'm conscious now of time. We said that would be shorter than we've done well to actually extrapolate anything from that budget presentation yesterday. Just to highlight a few points, I think this is a time to actually look at your personal circumstances as well as your business. With a lack of announcements means that actually you've got certainty in your business and in your own private life and a chance to look at financial planning, business planning, particularly around in business, investment that might bring down costs, investment and tax planning in terms of around workforce, recruitment, management and retention. So it's probably a good time to take time out to do that. Can I thank all our speakers, all three, Luke Prout, our corporate tax partner, Kelly Goodchild, one of our tax managers, and Sam Tindale, one of our financial planners, for their presentations. As I say, I think the nuggets to take away are around what you should be doing now and not necessarily what the Chancellor said yesterday. In the handouts, you will notice there's if you click onto the handouts on the screen, there's a copy of our autumn budget summary to take away, and we will share a recording and the presentation after this event. May I thank you for joining today. We trust you found the presentation useful. Forgive us if there was a slight technical hitch in various throughout the presentation. We're trying new ways of working like everybody else, and we will master it and we will move forward. So thank you for joining us. Those people that have asked questions in the chat, we will stay on after this presentation just to respond to those if they want to stay on as well. But may I wish you a good rest of the day and a prosperous 12 months, and hopefully the next budget will still stave off some new changes to taxation. Thank you.